recording. So so hi everyone, this is Finance Meets Real Estate. So as you guys know, we meet here every Tuesday, 6:30 p.m. Eastern time. And we have usually guest lecturers, and we also do networking socials like this one tonight. So basically the format is not the same. I got a question, not the same link each time actually. So different link every time. And I'm gonna share our group on Meetup and so forth, like on the chat later with people as well. So we're on Meetup, we're on YouTube as well, and LinkedIn. So basically today the format is just an online networking social. So if you guys feel free, I'm gonna permission like screen sharing. So if you guys wanna like even like pitch anything you guys have, what you're doing, feel free to do it. This is gonna be on YouTube also tomorrow. And so I'm gonna do the same and kind of give it a start. Okay, so let me just 1 second. Okay. Okay, so I just shared my screen. So yeah, so about myself. So I'm an investor myself. So I'm in New York City, and I'm founder of RealtyQuant. So my company does data analytics for the real estate industry in terms of market analytics and also property analytics. And I'm a financial engineer before in my previous career, and I invest in multifamily, smaller and bigger multifamily both, mostly in the Northeast. And I speak at events on analytics, like is the real estate market overvalued, and also whether, and also like data-driven real estate investing, how to use like machine learning and other techniques to kind of streamline and automate and improve your real estate investing. I've been on different podcast events, university lectures, and others. That's kind of like my profile. So basically, investor / analytics person, if you will. So this is my company. So currently, so we have two products. So one is like market valuations data. So that's very useful to the lending industry. It's also useful to investors in terms of kind of statistically estimating for all US, really every market in the US, which markets are overvalued or undervalued, and what downside risk they have in a recession. And I also have a product on commercial multifamily lead generation, which basically in 100 US cities, it uses rental listings data to estimate which apartment buildings in those cities have the most value add. So that's another thing. I have also a data-driven real estate investing course that I haven't had too much time, honestly, to do once again. But this is like data analytics, financial modeling, machine learning course, if you guys are interested. And again, if you want to get on also like my investor list, it's so realtyquant.com/invest. So that for like different projects. So I'm currently working on acquiring 3 projects. So they are not accredited investors. They're non-accredited investors, if you will. So I can't share too many details for them here, but basically we have a total of 120 units across those. So that's kind of information about myself. If you guys wanna like do the same, if you wanna kind of share your and let me actually just put our YouTube channel here as well. I'm gonna put it on the chat. So it's Finance Meets Real Estate on YouTube, and I'm putting the link also on the chat. So yeah, so go ahead. If anyone wants to like speak up, kind of like, or share what you're doing, like you can raise your hand perhaps and do so. Yeah, Scott, perhaps you, if you want. Okay.
Sure. Yeah, I guess I'm the only other person on camera, so I can't tell if anyone else is like gearing
Yeah.
up to do it. But yeah, I can share. I didn't really prepare anything to talk about, but I guess I can share just to give a visual, like we did during one of these other networkings with my website just as like a background, something to look at. And then I can tell you guys a little bit about me. Looks like we lost somebody, but we still got 3 other people left.
Yep,
That's
yep. No,
good.
it's okay.
Okay. So, all right, here we go, guys. Can you see that?
Yeah.
That worked. Okay. So this is just to kind of give you something funny to look at while I'm talking with me sitting on top of this machine. So I'm Scott. I attend most of these events. I found Stefan originally on Meetup, and we've just been in touch and friends since. And um, really enjoy these sessions. And that's because I've been investing in real estate pretty much my entire adult life. I've been doing it about 11 years now. I started with house flips, and I still do a lot of house flips to this day. But I've kind of branched out a little bit over the years. My bread and butter is still buying single family homes, fixing them up and selling them for a profit. But I've also done some short-term rentals and some long-term rentals. And I've done a couple of commercial deals now, one office and one medical, which were over the course of the past 2 years. I'm really trying to do more commercial, but I'm finding that to be pretty challenging. There's a lot of competition, and there's really deep relationships with a lot of the big buyers in town and a lot of the brokers in town. So most of the good deals never make it to market. So I don't know how I'll break into commercial eventually, but that's my goal. But anyways, along with flipping all of these houses, I had a full-time job for um, basically up until last year. I worked in corporate America and kind of climbed my way up the corporate ladder. I started as a mortgage loan officer, and then I spent time in mortgage processing, underwriting, and worked in both first mortgage and home equity, doing home equity lines of credit. And I just was investing in real estate on the side. But now I do real estate full time. And because I have a little bit more time on my hands since leaving my corporate job, I have been building out this online business, which is why I have a website. I've never had a website before. But I figured, okay, if I'm leaving corporate America and pursuing real estate full time, that's one source of income. But I'd like to build an online brand for myself and then help other people to learn how to invest in real estate if they're interested in flipping houses or buying rental properties or whatever, and entertain them as well while I'm at it. So most of what I do online right now is YouTube. I can pull that up, but my YouTube, actually, that's on this button. I can just go here and click that. Um, so I do a lot of YouTube videos about real estate. I mean, all my whole YouTube channel is about real estate. Mostly what I cover is real estate related news. So just like really interesting headlines that are happening all around the world. But I do cover some details on some of my projects that I'm doing out here in Arizona as well. Like on this one, I talked about how I found my contractor for a spec project that I'm building right now. So that's one example of my videos. And then others are Mark Wahlberg's trying to sell his $80 million mansion in California. So my YouTube channel is kind of a mix of just real estate news and stuff like you can see up here. So if you guys are into that, you can follow me here. Or if you're interested in more of the educational stuff, that's what my website's all about. But I'd be happy to answer questions if there are any, but that's my scoop. I did a whole interview with Stefan a few months back though. So we got into a lot more detail about my background then. So I don't need to get into too much more now, I don't think.
And so actually, Scott, I'm not sure in terms of like the mentoring that you have, do you wanna show that one a bit too?
Sure, yeah. Yeah, this button actually here at the top. So it says schedule a 30-minute call with Scott. I put here is to talk about real estate investing, buying your first house, funding deals, building your team, building your brand, starting a YouTube channel, whatever. But if you want to meet with me one-on-one, my calendar is linked right here on the website. So you can just click any one of these time slots this open. And this has been a fun way to connect with people who follow me, because we're able to just have more intimate conversation about their scenario. And so, yeah, if anyone's interested in mentoring, you can just click that button there and boom, you'll link up to my calendar, and it's a real one-on-one Zoom call with me. In the beginning, I was doing a lot of Zoom calls and meetings and stuff like for free because I felt like I know this is valuable what I'm offering to people, but I just felt weird charging for it. And then I kind of had like a social media consultant a little while back who was like, dude, you need to be charging for some of these things. You know, you're not a charity, you are a business. So it has evolved into a oh, sorry about the dog. Let me shut this door. It's evolved into a situation now where the mentoring services are something that you need to pay for, which I know not everybody loves. I don't love it either. I'd love to give all my information and experience away for free, but that's what this is for, just so we can have like a more tailored conversation to individuals' needs. And what I found is most people who book these calls are very new. Like they're interested in buying their first house or buying their first rental property, or maybe they need help picking a market. And so I can help them pick it with a market, although Stefan, you do a lot better job at that. You really know how to pick a market better than me. But
Oh.
that's what this is all about.
Okay. Mhm. Right. But so how do you get the leads? Because you're saying they're more like starting investors, right? Like, do you get them through your YouTube, or how does it work for
Yeah,
you?
so my YouTube, mostly because the link to this is also in my YouTube. So like in all of my YouTube descriptions, like if you click on any one of my videos,
Mhm.
um, this will play. I gotta pause this so it doesn't make a bunch of noise. Okay, here we go. So like here in the description, maybe you do this, Stefan, or if anyone else on the call has YouTube, um, I put like my course, a link to an investing course I have, my newsletter that I put out every week, some free just calculators that I use that I created for my house flips and rentals and stuff, and then meet with me one-on-one. So the link to my booking page is right here. Can you see this too still?
Right. Yeah.
Yeah. Okay. So through this link, I get some bookings, but also through Instagram. I haven't been on Instagram very long, but well, I have been for my real estate development company, but for this online brand, I started that maybe just like 6 months ago or something. And what I found, I don't know if anyone cares to know this, but I'm posting a lot of like real estate tips on my Instagram. And let me show you just, and I won't bore you guys with this too much. If you guys are here to talk about real estate and that you don't care, then I'm sorry. But since you asked, so what I found this cool about Instagram is, so I only have 382 followers, which is like nothing. But if you look at my reels here, all the ones, oh gosh, I'm posting 2 of these reels every day. And if it ever loads, what you'll see is I'm posting real estate investing tips, and these are getting thousands of views. So even though I don't have very many followers, the reels, like I think my account has reached like 20 or 30,000 people in the last 30 days or something like that.
Um,
So a lot of leads come from this. It's crazy. I'm learning a lot about the power of Instagram and social media. Like as we speak, I'm still very new at this, but I created this link tree thing, which
mhm.
also has a link to like the mentoring and stuff, but it doesn't seem to be wanting to load right now. But yeah, to answer your question, Stefan, it's from YouTube. But a lot of people who watch these news videos, they don't really care about mentoring or learning about how to flip houses or whatever. They're just looking for entertainment. And so I think the Instagram is a better source for leads. And then
Mhm.
I've run ads also, but I'm not running ads right now. But I have run some ads on Facebook, and I've had some good luck with that, with like building up my email list and stuff.
Right. So let's say, so the reels on Instagram, is it, because I know we spoke before, and it loaded, right? That's good. So like those, is it the
This
similar
page.
approach to YouTube, where it's a function of, so how many people ultimately see it? It's kind of a function of, okay, the thumbnail and kind of the click-through rate, and then the duration or something, or the average, the viewing duration. That's kind of like on
Yeah,
your discussion. But then how is it here? Yeah.
it's so reels are pretty cool because if you just post a picture on Instagram, it just like goes to your friends and that's it. But if you post a reel, I'm not an expert in this, but somehow it gets
Yeah.
pushed out to way more people if you post a reel. So you can see like this one about accessing your home equity got 213 views, but this
Mhm.
one got 3,700 views. This
Mhm.
one, I did the most expensive part of Airbnb investing. It got 3,482 views,
Right.
and I only have 382 followers. So
Right.
somehow Instagram is finding people who are interested in that and pushing it to them. I wish more of them would click follow because that'd be nice to have more followers. But you can see some of them only get a few views. Like, do
Mhm.
lenders offer 100% financing on multifamily? I guess no one cares about that. It only got
Yeah.
77 views. But then this one, wholesalers should target these owners too. that got 2,700 views. So it's kind of like YouTube where you can put them out and sometimes they get a lot of views and sometimes they get not many views, but I just keep doing it every day because from what I'm told, like, look, this one got 37,000 views. From what I'm told, you just keep putting out reels and some of them will work and some of them don't work, but you can't get too discouraged by it. Just keep more. And so that's what I'm doing.
Right. Yeah. Very, very consistent. Wow. Great. That's awesome.
Yeah.
So, right. But the reels, are they when you kind of, I'm not like super active on Instagram, like when you kind of actually like post yourself in a way? And is that like, I mean, are the reels when you record yourself or can you just post any video as a reel? You can post any video as pre-recorded video.
Yeah, you can. Yeah, you could post anything. Like you could post this as a reel if you want, but it has to be a certain. It has to be shorter. I think it's like 60 seconds is the max or something. So you could like take part of this video and then make it a reel.
Yeah, sure. No, that makes sense. That makes sense. I was under the impression it's a little bit of like kind of like those live things where you need to like record yourselves at the same time or something.
Oh,
okay, it's not.
yeah.
Yeah, I'm not too. Yeah, sure. That makes more sense. Okay, cool. Yeah, that's great. So you've been doing more of the Instagram recently, basically, right? That's awesome.
Yeah, trying to grow there one at a time. I mean, there's all these people out there who you see have like a ton of followers, but what I've learned is a lot of the people you can pay for your followers, like they fake it, you know. So I'm trying to do it the right, honest way. Just I'm growing slow, but that's okay. I'm just gonna keep putting them out, and eventually it'll probably pay off. But all of this is still like a big real estate business that I'm building that hopefully, like, if this whole thing generates more money, then it will be rolled into the real estate deals, which will give me more content to put back on the Instagram and YouTube. And so it'll kind of complement each other really well. But for now, it's just more, I don't want to say it's a hobby because I treat all this YouTube and Instagram stuff very seriously, but it kind of is, you know, it's like, it's more of a side hustle. The real estate work is still my full-time gig right now.
Sure. Yep. Well, you've been like doing a lot of videos. That's that's a lot of work though, right? It's for a side gig, right? It's
for sure. You're right. Yeah. I mean, I put out 2 a week at least, sometimes 3 a week.
Right. Okay. Well, yeah, thanks, Scott. Appreciate it.
Yeah, it's fun to share. If anyone has questions, I'd be happy to answer, but I'd love to hear what everyone else has going on too.
Cool. Yeah, so I see Ethan. How are you doing there?
Hey guys, how are you?
What's up? Yeah, we're just doing like small social here. So I was wondering if you want to share like what you're doing. I know you've been on our channel before.
Yeah.
So you kind of like share screen and you can show your company or what things you're working on, kind of like can be self-promotional too. And it's gonna be on YouTube tomorrow too. So
Sure. Yeah, I don't have anything to share on my screen, but I focus on 2 things in real estate in particular. I've been a corporate lawyer for a long time, over 16 years, and I transitioned into doing a lot of real estate investing about 8 years ago. But the 2 things I focus on are being a key principal or a loan guarantor on deals. I'm on a bunch of teams across the country in properties across the country where my role was to provide the liquidity in the balance sheet to qualify for the loan. And then the other thing that I do is I make short-term loans to primarily syndicators that have raised about 80% of their capital stack. But if they're missing the last 20% or so of the limited partnership money, I'll come in and I'll lend them that difference so that they can close their deal.
Mm-hmm. And so presumably afterwards, and actually, I had you here on this webinar, right? And you spoke on like being a key principal, which is a very interesting topic. But in that scenario when you actually would lend them the funds, and excuse me if I've asked you this before, perhaps, but is it that then they would kind of like backfill the equity after the closing? It's just sort of like a timing thing for them.
That's exactly right. That's the ideal scenario. Sometimes I've also done just regular special situations loans. As long as there's a path to getting paid back within about 4 months, then I'm interested. If it's going to take longer than that at the initial stage, then I'm not super interested. But if I've already made the loan and, people need an extension to 6 months or something, that's not a big deal. But
Right.
out of the gate, if somebody tells me, hey, I've got a great 6-month deal, I'm not super interested. It's
Yeah.
I'm more interested in short term.
Right. Yeah. I remember that. And you have a lot of relationships in the industry yourself with sponsors. So it helps to kind of, I mean, I'm sure it's necessary for what you're doing now, right?
Yeah, I have a decent reputation. I get around, I go to a lot of networking over Zoom and everything. So that's where I meet most people. I also live in Houston, which is a big market, so I already know some people just locally. But yeah, I've done this type of business across the country on deals across the country. It's pretty similar. I mean the classic fact pattern is somebody's raised 8 million, but they really needed 10 million and they're short 2 million, then I'll come in and I'll lend it to them.
Right. Have you worked with Amy, let's say, in Houston, or Amy Tiemann, or someone?
She lives in Austin. I have not
She's in
worked with
Austin
her.
now. Yeah, never mind.
Yeah, I don't think she's never needed me. Several people that host meetups have actually needed me, and I've done deals with them, or we've made it very far down the line. But a lot of times, what happens is they end up raising the money in time, so they don't really need me anymore.
Yeah, sure. I see. And I mean, you're focused, but do you invest in any like syndication yourself ever? Sounds
No.
like not much, right?
No, absolutely not.
You don't like
I'm not at all. I'm not at all interested in having any sort of passive or limited role. I'm extremely active in my own investing.
Mhm. But
So
even
even if somebody had a better deal, than what I do, I wouldn't invest in it. Doesn't matter.
possibly, yeah. Okay, that's understandable in terms of like actively investing, other than a key principal role in terms of like managing it. Sounds like not so much either, right? It's not your preferred. You kind of
No,
prefer
my preferred strategy is short-term loans. So that's all that my money does.
Right.
And that's all it's going to do. I literally will not have any other strategy other than that strategy.
Right.
Until people don't need short-term loans anymore. I'm just going to be doing that one strategy.
Got it. Right. So yeah, it's you have a risk profile basically that you follow.
It's not even a risk profile. It's just an investment strategy. So that's my investment strategy.
Risk tolerance within your investment strategy, if you will, I guess, in a way, right? So, but okay, great. So, what have you been up to? Like, what's new, with you?
Since you interviewed me on that
Yeah.
podcast, I think I've done like 7 different deals like that.
Nice. That's awesome. That's great. And so that's the more on the lending side, sounds like.
Yeah, I tend to get more requests for lending than I do for key principal. But I'm interested in both. I mean, the more leverageable business is being a loan guarantor key principal.
Sure. Yeah, sounds good. I will be in touch with. I'm working on several deals now. So if I need like some of the closing funds on one of them, I would say the bigger one of those. So I will be in touch actually.
Okay, great.
But yeah, sounds good, Ethan. So yeah, that's great. And so you're in Houston, right? So
yeah, I live in Houston, Texas.
You live in Houston, yeah. Cool. So let me try to poke somebody else, like Riley. Do you wanna join? Yeah. Okay. Cool.
Yeah. Sorry, my camera's not up. It's actually on. So.
Okay.
Yeah.
Okay.
But yeah. So I'm a GP in multifamily sponsor. Right now, I have one business partner, and we have a few complexes in the Midwest, and we're working on another 250 units in the next 6 months or so.
Mm-hmm.
And I also have a firm that I guess I'm starting to get some momentum with, which does asset protection and tax planning at the same time. And it also uses estate planning. It uses some of the provisions in the law for an estate plan that kind of use the
Mhm.
law to the advantage of the investor. But I find people who need asset protection or some sort of estate planning. And oftentimes they're also interested in investing in multifamily as well. And so those businesses kind of feed each other.
Mhm.
And it's pretty rare to have a firm that does taxation and asset protection or trust law at the same time, mostly because in a lot of states, it's illegal to have your accounting practice under the same business as the law practice. Utah allows for that, and Arizona allows for that, and a few other states are starting to pilot programs that allow for that. And so it's pretty unique, and that's been, like I said, that's been getting a lot of traction lately.
Right, that's great. And so that's your, and kind of on your LinkedIn now, so that's your
Oh yeah,
so Flying and Group is your investment firm, right? Basically.
yeah.
Your like
It's a group
syndication.
of companies, but yeah.
Okay. Uh-huh.
Flying End Management is on the multifamily side. And then there's another firm, a few firms that I've kind of put together to do the asset protection side.
Mhm. Got it. Got it. Do you want to actually, maybe if you want to try sharing your screen, maybe that will work. If you want to show you like the website or something like that.
Yeah, I mean, I could share. Let's see. Does it let me?
Oh yeah,
Okay.
that works. Yeah. Okay, cool.
Let's see. This is one of the, this isn't the only strategy, but this is one of the strategies that we implement.
Mhm.
Basically, we changed the ownership structure of their holdings so that on paper they don't look like they own anything. And we changed the movement of the profits so that we can take advantage of as many deductions on their taxes as possible.
Mhm.
And I mean, a well done asset protection plan will take care of their estate planning needs, and it'll also, or it should, reduce their taxes by quite a bit. We utilize a C corporation a lot. We almost never use S corporations, which it shouldn't be as controversial as it is.
Uh-huh.
C corporations are used by larger asset protection firms all the time, and tax planners. If you know how to use it, so you would avoid double taxation, they're much, much better than an S corporation, both for taxes and asset protection. S corps, I hate them personally. They have so many issues that people don't really understand if they're not, in the line of work that I'm in.
Mhm. But this
I've
is
worked
quite
with,
interesting. No, go ahead. Go ahead, Riley. Sorry.
yeah, I mean, one of my clients, if you've heard of him, CoffeeZilla,
Okay,
YouTuber.
I see.
Yeah, I definitely have.
Have you? So I've
Oh
worked with
yeah.
him. So he's dealing with something called SLAP lawsuits, which are strategic lawsuits against public participation, or frivolous lawsuits, or what some people call them. It's basically a lawsuit just meant to intimidate and bully someone into submission. They're not even meant to win the lawsuit. It's really just meant to stop someone from doing what they're doing. And he was obviously revealing a lot of financial scams, and he was being doxxed. His personal information was being posted online, and he just couldn't get away from these people. And so we created some anonymity for him, and did some consulting with him so that he was a more expensive lawsuit target. There's nothing you can ever do to make yourself lawsuit proof, but you can definitely make yourself a lot more expensive to pursue legally. And so we did some consulting with him on that. And then, I mean, Airbnb investors use this a lot. You know, they typically have a corporate job that they're mostly focused on, and the Airbnb is just kind of on the side. They're not necessarily a savvy real estate investor. And so we kind of help them organize their business so that it acts a little bit more like a business and less like a hobby. And then some multifamily sponsors, you know, multifamily investors. We help people bypass the passive loss limitation rules so that they can take better advantage of a cost segregation, which is a big issue. You know, once you have used everything that you can in the cost segregation against your passive income, unless you're a real estate professional, you can't use that against your active income. And so we help people take advantage of that better.
So sorry, just to hold you there again on that
Yeah.
part, right? Because I literally took a screenshot of this slide because it's kind of like a wealth of information, right? At least for me.
There's a lot
At least for
there.
me. So it's like it's quite great. So in terms of like to the so the cost segregation side, if for COVID like non-RE professionals, let's say, and offsetting active income, passive losses against active income kind of thing, like what do you guys do for that essentially that could
Yeah, we help
yeah.
them basically generate those losses through an active business that's not just set up as a holding company. We set it up so that their main form of income is supposed to come from other means. And the real estate or the, you know, the losses that they're getting and the income that they're getting from real estate is kind of a side effect of their main business. At that point, the passive loss limitation rules are they're still there, but they're relaxed quite a bit. And you know, they have to show that they have material participation in the business, but it's not limited to a specific number of hours. Usually it's either 750 hours for a regular investor or real estate professional and 250 hours for a short-term rental investor. But there is no hour requirement if it's side income in an active business. It's not just meant for real estate.
So they're essentially like passive losses, is it sort of get incorporated into like their overall real estate activity and sort of get considered somewhat active partially, sounds like, and then that
the losses at that point, the losses are not considered passive losses anymore. They're considered active losses at that point.
Right. Okay.
So then the passive loss limitation rules are they don't really matter at that point because it's not passive income or a passive loss anymore.
Interesting. And then in terms of like, because I've had on this webinar, I've had like, let's say Brett Swartz, if you know, like who does like deferred sales trust.
Yeah.
Like, right. So so how does this feed into, let's say, the chart that you have on here, like something like a DST, which I thought that's like a more common technique for, I mean, it's kind of deferring taxation, but
yeah,
where would it fall into the chart, let's say?
Yeah, I mean, you can have your proceeds coming out of your LLC, for example. Those proceeds would go into that deferred sales trust or an installment sale trust. You want to be careful with that, though. You want to be careful the firm that you use for that, because it can really easily be considered a step transaction, which is not legal. You want to, yeah, I've been counseled against DSTs by the attorneys that I work with because of the issues that can come up. It doesn't mean that they don't work. They do work, but sometimes I don't know. I mean, I don't think that they've been fully tested by the IRS yet.
Okay.
I don't know for sure though. I've never set one up, but the IRS has what are called tax turkeys, which are loopholes or strategies that people will use, and they'll wait until a lot of people are on board with it and using it, and then they'll change the legislation, and they'll actually make it retroactive, which means they can penalize people, going back a certain number of years that have used it, even though no legislation existed against it at the time. And they'll bring in a massive amount of revenue, and that's when the IRS just reaches out to you with a settlement letter saying that they'll settle with you if you pay 50% or 70% of what you should have paid. And they're trying to pretend like, oh yeah, we'll settle, we want to make this as easy as possible for you, but it's more of a threat than anything. It's pretty passive aggressive when they do that. I think that the DST is going to be a tax turkey eventually. And I think that there's other ways that you can reduce capital gains that are just as effective and will be much harder to legislate against.
But let's say, so in light of like some of the cost seg kind of being phased out over 5 years, right? So 2023 already 80%, and next year 60%, etc. Right? So in that sense, what do you see is going to be like the best tool for investors for, commercial, residential real estate investors, if you will, for deferred taxation? If it's not DST, let's say, and if cost seg starts getting phased out gradually, and then 1031 exchanges are kind of inefficient somewhat, right? I mean, it's kind of more difficult to achieve consistently.
Yeah.
So what is your view on that?
I think it's hard to say unless you know how they're currently receiving income, and what their losses are. This sheet is an example of something that can be done, but it's not, the one all be all strategy for everyone. This is something that I have for myself, and this was best for me in my situation. But for someone who owns, all of their net worth is in limited partnerships, it's going to look different from someone who has a tech company as their main source of income, or as someone who has single family. So that's a really hard question to answer.
Okay.
I mean, maybe having a central management company that is maybe an LLC or C corporation that kind of manages all of your other companies or businesses or ventures or assets, whatever, but then also has holdings in a limited partnership or something along those lines.
But overall, since and that's not something, I don't have like the same knowledge, let's say, that you guys have, sounds like, right there, in terms of, so let's say like that's something where sort of the overall asset protection, it's a holistic comprehensive asset protection structure that is kind of individualized, is really the answer to like consistent deferred taxation for investment, sounds like. Not so much a single tool such as be it cost seg or DST or 1031 or whatever. And I know you spoke on DST in like as a tax turkey potentially like in the future in that way, but yeah, so it's not like so much any of those specific tools. It's just more like for your individual situation, being able to devise a holistic asset protection structure. Is that a fair statement?
Yeah.
But
I mean,
let's say, using as an example the one you have in your chart, is that something that can achieve the same effect of a cost seg before, or DST, which is basically eliminating all capital gains nearly, like in assuming one is efficient at acquisitions and so forth, there is a business, it kind of almost stems from being productive in your business, right? Being able to minimize your taxes.
Yeah.
But then here, without that, without being able to channel new acquisitions all the time, like how would it get achieved through this structure? And what is this structure being rewarded for really? Because my understanding always for all those tax, kind of like tax deferral strategies is in a way, I mean, one, it's a deferral, also it's kind of like transferring, kind of there's like a likeness type of thing, like kind type of exchange,
Yeah,
similar
like
like
kind.
1031, right? But also the other thing is it's like really rewarding business productivity in a way, right? It's just acquiring, it's like acquiring asset heavy businesses, you know, that have very high furniture, fixtures, and equipment, for instance, right?
Yeah.
Those kind of things, and like writing of tax deductions on that, and just doing this consistently. If you don't have a new acquisition this year or several new acquisitions, you're not going to be able to zero your income, so to say, or like eliminate your tax liability, right? It's only if you're productive. And so how does that fit basically here? In the event cost seg gets phased out, 1031 is not very efficient to do. DST, maybe a tax turkey to your point. How does one achieve it with this structure? And what business kind of effort one needs to put to be consistent with a structure like that, such as should one be very efficient at acquisitions, but at heavy real asset acquisitions, or what should one do?
Yeah. Well, the goal, if I'm understanding your question right, the goal is to have your losses meet or exceed your income.
Right.
And when your cost segregation starts to phase out, that's, you know, your losses are starting to diminish. And if they get to the point to where they're, you know, a lot less than your income, then you have to find losses in other ways. And sometimes that means moving your money into a new project and restarting that cost segregation clock. Sometimes that means taking a personal residence, placing it in a business, leasing it to your corporation, and then having your corporation provide it to you as a fringe benefit. That would allow your LLC to take the mortgage payments and utilities and maintenance of that property and turn it into a business deduction. You want to, you know, like I said, it kind of depends because, for example, if you're in Florida and you do that, you place your personal residence into a business to turn it into a business asset and business expenses, you will lose your 121 exemption for taxes. You'll also lose your homestead exemption, and in Florida, the homestead exemption is unlimited. So, you know, you want to look at your situation. In that situation, maybe you'll save $5,000 or $6,000 in taxes, but if you have a $5 million home, you now have $5 million of exposed equity, you know, just to save a few thousand. And so this is why, you know, there are strategies on the tax side that you can really reduce your taxes or even get to the point to where the IRS owes you money. But it can oftentimes is done at a massive expense on the asset protection side, like mind-blowingly large expense. And a lot of these accountants don't quite understand asset protection. They don't understand that side of or just law in general. And so they'll, you know, and they're good. They'll do what they've been trained to do, and that they can reduce your taxes as much as possible. But like I said, you know, if you're saving a few $1,000s a year on your taxes in exchange for exposing $5 million worth of equity, you know, that doesn't make sense in any world. But if you're in New Jersey where there is no homestead exemption, maybe that does make sense. So yeah, I mean, it just kind of depends. You know, maybe that individual will want to buy other kinds of businesses. You know, car washes, for example, you can deduct the entire value of the car wash in year one.
Yeah. Yeah, I mean, That part I understand. If they're acquiring like asset heavy businesses like FF&E, right, is what is referred
Mhm.
to.
Mhm.
That gives a lot of deduction that is comparable to the cost seg.
Mhm.
But if the cost seg gets phased out, but then not everyone wants to be acquiring businesses. It's like not an
Sure.
easy thing to do. It's kind of, yeah, sure, you make you sort of make that tax saving there, but you need to work for it a lot. There's a lot of
You
labor.
do, yeah.
And so
Yeah, yeah, it does add a little bit of complexity. A big thing with having a corporation or even an LLC is following corporate formalities. Um,
Mhm.
that adds some complexity. People don't understand it when they have an LLC. There are behaviors that an LLC has that a court wants to see before they honor your corporate or your limited liability protection. And a lot of people know that commingling funds is one of those things they look at if they're going to honor
Mhm.
that protection. But in a corporation, whether it's C or S, if you're not issuing shares of stock correctly, they could say, well, you're not following a corporate formality and we're going to pierce the corporate veil. If you don't have a board of directors, or if you are meeting but you're not keeping any records of those meetings, all of those things can be failing to follow formalities, and it makes your business look more like an alter ego than a business and a separate entity from you. So yeah, I mean, you have an administrative cost to doing all of these things and keeping up on them, and every year your tax profile, it'll look different, and so you need to kind of change the way that you're doing things. One of the reasons why we like C corporations a lot for real estate investors, especially single family real estate investors, is that they can deduct and do whatever they want with the funds that are coming out of it for a while. But then if they want to go and get a loan, depending on the lender, maybe they want to see 3 months of pay stubs. If you're W-2, if you're 1099, they're going to want to see 2 years of tax returns. But if you're W-2, the standard is way, way lower. So you can just pay yourself a W-2 out of your C corporation for a few months, qualify for that loan, and then you can revert back to what you were doing. But if you do that with an S corporation, you're going to get penalized for not paying yourself a salary every single year that S corporation is alive.
Mhm. So the C corporation, so what it allows you to do is it's sort of like how those salary payments get handled, and like what is the main like distinction again? Like I know you kind of have it listed there and you mentioned, but just again like to repeat.
Yeah,
Or...
I'd say the main ones, the corporate tax rate is a lot lower. You're not taxed on reinvested profits, which is huge. If you leave, you're in the C corporation, you're basically just taxed if you're leaving profits in the corporation at the end of the fiscal year. If you can find a way to zero it out, then you don't have to worry about that corporate tax rate in the first place.
Mm-hmm.
So the entities that money is moving to have to deal with the taxation. If you're going to pull out a salary or a distribution from the C corporation, it'll be taxable immediately. But if that corporation is paying for consulting or rent of an asset or something along those lines, then the funds are leaving the C corporation as an expense and not payment as a distribution or salary or a dividend. And so it defers the taxes of the funds that are pulled out of it. So that's a huge one. Is when it gets taxed, how often, and where. Another huge one is C corporations have no limitations on shareholders. It can be a trust or a company or an individual, and they can be anywhere in the world. With S corporations, only individuals can hold shares, which means there's no ability to have anonymity in an S corporation because an actual person has to hold its shares. The C corporation, you can have your family trust own all of the shares in the C corporation, And at that point, you know, you're the only, I guess, public thing that people will be able to see about you is who the registered agent is on that C corporation. And if you set it up with a law firm, it'll be the law firm that's the registered agent, and so no one will really know anything about you. And so if they do, for example, if you cause a car accident, you rear end someone, and you know, the person gets injured, and they want to come after you for more than what your auto policy will cover you for, they may go to, you know, one of these hundreds of personal injury attorneys that are advertising all the time and say, hey, you know, someone hit me, and their insurance is only going to pay out $250,000. You know, let's go get them. That attorney, the first thing they're going to do is an asset search on you to find out if they win a lawsuit against you, do you actually have the net worth and assets to collect on? And if you don't, they won't even take the case, even if they know they can win, because there's nothing to collect at the end.
Yeah, right.
So if they can't find your assets, they can't find your holdings in that corporation, or even be able to see that you have control of it, it's going to make you a lot less attractive to those types of lawsuits.
Mm-hmm. Right. So no, the asset protection side, yeah, it's very understood in that sense, but purely on the tax saving side, if you will, is like a structure like that gonna be very beneficial? Let's say if we suppose a world without, just purely for real estate, focusing, let's say real estate investors, and in that case, supposing we have a world without cost segregation in the future, all right, which we will, sounds like, at least for some time, or like a few years from now. And so suppose in that case, and then DST may be not a very viable route, to your point, and just purely focusing on the tax saving side, not the asset protection from lawsuits and all that. To what extent you see this? Because the current situation is like basically a lot of, like you mentioned, syndicators or like multifamily investors essentially ending up with zero taxable income, you know, like that's kind of the situation there, right? So essentially, how much of that could be retained by your structure on the tax saving side? Is it 20% of it or 50% of it, if let's say cost seg and some of the other?
If the cost seg was done away with, you'd still need to find a different way to source those losses. The biggest thing going for you is that C corporations are taxed at 21%. S corporations, you're going to be paying about 37%. And because you have self-employment tax as part of that. Same thing with LLCs. The benefit of a S corporation over an LLC is that on your salary, you're not paying self-employment taxes. It's only on what is left over after you pay yourself. So, and that, you know, that one isolated scenario, the S corp can be better than the LLC, but then the C corporation is going to be paying less tax overall, period, than the S corp. Also, C corporations have more deductions available to them, and you have the ability to offer fringe benefits to your employees with a C corporation.
Right. So there will be some tax saving from that, kind of sounds like. So one would be able to source more losses, have the better tax rate perhaps, and have some tax saving through, and like losses offsetting other income and so forth, to some extent. Not like to the extent of actually removing like more significant taxable income.
It just, again, it just kind of depends on what type of income we're talking about, and you know what the losses are to begin with. You know, if you're bringing in currently $1 million a year in income and you have basically no losses, it's going to be really difficult to find ways to generate those losses. If it's just a little bit, it'll be a lot easier. But you know, that's a big reason why people are investing in real estate to begin with, is that bonus depreciation from the cost seg.
Right. That's true. Right.
It's a massive,
And so-
massive source of losses that you can use.
Correct. But then, so you have your contact information on the screen, like for everyone to see. And in terms of how do you guys get like compensated? I don't know, like how public it can be and so forth. But so to say, like if one wanted to employ your services, is it a flat fee, or is it like on the tax saving side, let's say percentage of like tax saved or so forth, or respectively?
Yeah, we're reworking that right now. It was a flat fee based on the service. And right now, we're just, we're trying to figure out what the best thing would be. If you're charging $1,800 to set up an LLC, but someone needs 20 of them for one state. After a while, the service, you're kind of doing the same thing over and over, and it can be pretty quick. And so you don't need to charge $1,800 for the 20th LLC. You can justify it on the first because you have to set everything up, but once it's all set up, you can reduce costs after that. And so we're working on ways to do that.
Okay, sounds good. That's great. Well, thank you so much. That was actually really great value. Things to look into, and so hopefully like more people will reach you also after this. Thanks, Riley. I appreciate it.
Yeah, absolutely.
Great. I think I should let's connect after this. I should have you on to speak at this channel as well.
Yeah.
So if you would be free like later, either end month, beginning of next month, perhaps something like this, if that works. Okay, so I will be in touch, and so thanks for that. Thanks to everyone for joining here tonight, exchanging their what they do, what everybody does, etc. So I think it was great. Thank you guys, appreciate it, and have a good night.
Thank you. You too.
I guess.